Good morning, everybody, and welcome to Beat the Bell, presented by Kane Capital. It's a new week full of brand new opportunities. The market is higher after what was a pretty solid squeeze last Friday. We finally broke out of that range. For those of you that were watching Friday's show, we were sharing our frustrations. Having watched the market trade in a 100-point range for 2 straight weeks, traders were ready for a move, and we finally got it. So now raises the question of, will we see continuation? So far this morning, things look good in the pre-market. Futures trading higher. I'm ready to go, excited, ready for a new week. Let's get into the show, guys, by introducing our panel. starting with Money Mander. Mander, good morning.
Morning, happy Monday. I'm at the point as bearish as I am. I don't even care if we break to the upside. I just want to get out of this range as soon as possible.
I don't think anybody cares at this point. We just wanted the market to move. I'm with you there. Diamond Trades, good morning.
What's going on, guys? I saw something on Twitter that was like, congratulations, you got wrecked by the range for 2 weeks, and then we broke out of the range and you tried to fade the trend all day. I just thought it summed it up so great, like what happened to so many people. But I'm glad that we're out of this range, and hopefully we can get going here.
Because you know what it is, when you start to see that breakout, it feels too good to be true. It was too textbook, if that makes sense. Ramsey Rippers, what's going on?
Morning, my man. Yeah, let's see if it's continuation. I mean, I definitely hope so, and I hope that it's not a classic trap. So we'll see what happens this week.
All right, Mo Mamba.
Good morning, guys. So, well, you did say it best. We finally broke out of this range, and as for a swing trader, it is huge. I mean, it's been absolutely nasty the past 2 weeks. Swinging any taker with this range, it has been brutal. But are we going to get back within range? Tune in for that market analysis later on.
Oh my God, back in range would be dreadful. All right, Snipes.
Good morning, guys. New range, old range, I don't really care. Let's get some bags, let's make some damn money, and let's go back to sleep.
That's right. Snipes is ready to go. All right, let's get started with the show, beginning with our Fed forecast with Money Mander and Noah. What do you guys got for us?
Yeah. So let's start with the economic calendar for this week. So this week is going to be a pretty volatile one. 1 second. There we go. Okay. So the economic calendar, we've got New York Fed expectations and Fed Bostic speech today. Tomorrow we have Fed Powell speaking at 9 a.m, which is going to be pretty important. He's speaking in Sweden, in Stockholm. He's discussing central bank independence at a symposium organized by the Sweden's central bank. Wednesday is going to be relatively light in terms of news. And then Thursday is really going to be the highlight of the week, obviously, with some Fed speakers in pre-market, and then CPI coming out at 8:30. So last CPI came out December 12th or 13th, one of those two. And it marked the December highs, right? We took that like 40-80 level and then sold off a solid 200-300 points. Last CPI came out at 7.1 versus 7.3 expected. This CPI expectation is around 6.5%, with core CPI expected to be around 5.7. So we're seeing this continuation of that CPI decreasing. Let's see if that trend is going to continue. We can move over now to, I guess we could finish up with the economic calendar. We still have import price index on Friday, and then also UMIS sentiment, consumer sentiment index on Friday as well, Friday the 13th. So to wrap that up, let's move over to the bond market. So one thing that Manny and I were talking about this weekend is that the bond market seems to be calling the Fed's bluff here. So Ryan, if you want to pull up that chart of the Fed participants for me, the other one, the Fed participants chart. Beautiful. Okay, so the Federal Reserve, the FOMC committee, their participants are expecting rates to be around 5% at the end of next year, right? The majority of the FOMC participants, as you can see there, have the federal funds rate by year end, ending the year in like the 5.13 to 5.37 range. And the bond market doesn't quite agree. We can go back to that other picture, Ryan. As you guys will see on the maturity yield curve here, the highest yielding maturity right now is the 6-month yield at 4.8%, right? Which is obviously below that 5% consensus that sort of the FOMC members have. And so looking at this, I sort of extrapolate this in two ways, right? One, either the bond market believes that inflation will come down substantially enough to change the Fed's mind about hiking rates up into that 5% territory, or they believe that rising unemployment will prevent the Fed from taking rates further into restrictive territory, or both, right? And so the market is sort of pricing that the federal funds rate is going to come down actually in the second half of 2022, which has led to a bit of a rally in some of those more risk-on assets. We got that information from Markets and Mayhem over the weekend. And so I think it's really interesting to see you have the bond market sort of saying one thing, you have the Fed saying another thing. Who do you think sort of wins this stalemate, and who do you think comes out on top, Mander?
So clearly the bond markets are calling cap here on the Fed, right? So what it actually was the median projection rate for 2023 was 5.1%, with 17 of the 19 projecting over 500 basis points over 5%. And so when you initially posed me the question, I was going to give my personal opinion, but I've done that about 20 times already. So instead, I pulled a quote directly from the recent minutes release that I wanted to read for you guys. So in the recent minutes release, they stated, participants remarked that the current configuration of nominal yields with longer-term yields lower than short-term yields has historically preceded recessions and hence bore watching, right? They noted the 210 inversion. We've covered a bunch here. Then they continued that because monetary policy worked through the committee's reaction function, a number of participants emphasized that it would be important to clearly communicate that a slowing in the pace of rate increases was not an indication of weakening of the committee's resolve to achieve its price stability goal or judgment that inflation was already persistent on the downward path. Basically, they're saying if they give a pause at any time, that does not mean pivot, right? That means what it states, and it would be a pause so they could monitor data over the coming months because they're reactive versus proactive. They want to see, instead of hiking continually and then sending us into a recession, they want to gauge the data, right? But here's the kicker. Several participants commented that the median of the participants' assessments for the appropriate path of the federal funds rate in the projections release they posted that we just talked about, that 5.1%, tracked notably above market-based measures of policy rate expectations that you just showed, right? The yield curve is below their projections. And they stated that the projections of 5.1% actually underscored the committee's strong commitment to returning inflation to its 2% goal. And then continued for the nail in the coffin, stating not a single participant anticipated that it would be appropriate to begin reducing the federal funds rate target in 2023. And so to me, right, I don't know how much clearer they have to make it. Obviously, they're calling bluff on the Fed and whatever it is. Somehow, whether they're pricing in a soft landing may still be possible, or they're pricing in that we get sunk into a heavy recession sooner than expected with unemployment rates skyrocketing and they have to backtrack and bail out. But as it currently sits, I'm very confused because the Fed could not be any more resolved in what they're stating and actually attacking directly, stating that I don't know why the markets are not taking us seriously, right? They're literally saying not a single participant has any projection of lowering rates, no pivot in 2023. So I'm just as confused as you are. I don't really have an answer, especially as NFP came in on Friday above consensus, right? There were more jobs added and unemployment rate came in under consensus, actually lower month over month. So the labor market actually strengthened month over month, not only coming in below consensus, but lowering from the month previous. And so until the labor market cracks there, I don't see why they would have any reason to pivot.
I mean, look, I think that CPI on Tuesday is going to give us a good insight into sort of what the next steps are going to be and how that looks going forward. But I completely agree. I think the delta between what the markets are saying yields will be by year end and what the Fed is saying yields will be by year end is going to be an interesting shakeout here over the next couple of months as data continues to come in. So we're definitely monitoring that situation, and I'm sure this won't be the last time that we touch on it. But that'll do it for us here at Fed Forecast, and we'll pass it back to Alejandro.
Awesome, fellas. Thank you for that. Let's talk about the system, everybody. So as we had mentioned earlier in the show, we were trading in a super tight range in the S&P for what was the course of 13 days. On the 14th day, we finally got a breakout over the top of the range, which we'll call this 3870-ish level. All right. Lucky for us, the system did give a buy signal while we were getting that breakout. Now, I understand that it was likely pretty tough to trade this in real time. I struggled to believe that the market was going to break out. But now what we can do, knowing that bulls are in control for as long as we're trading above the 50 SMA, is look for dip opportunities to go long. Something that I'm really focused on today is the 10 SMA on the 30-minute SPX chart. And the reason being is because, of course, it's our visual representation for momentum in the market. For as long as we're trading above this 10 SMA, guys, we could see this squeeze really start to catch steam. We could see this thing really start to go. What we see after a nice bull run, after a move higher, is two things. We either get 100 points extended from the 50 SMA on the 30-minute chart, and then things cool off. So keep that in mind. If we get 100 points extended from this blue moving average, the 50 SMA, you could put it on your chart. it's likely that the market will cool down. That's the first thing. The next thing is that if we break below the 10 SMA, that's our visual representation that some of that momentum is being lost. Now, not all is being lost because we're still trading above the 50 SMA, but the strength and magnitude of that move is starting to chill out a little bit. So that's really what I'm going to be watching for headed into today. Now, as far as trading this move long, again, I think it's important to wait for opportunities for the market to pull back. Maybe take a trade off of 10 SMA support. See if the 10 SMA is serving as trend resistance. We also want to be watching the hourly chart that is telling the same story. As you can see, we're a bit overextended from the 10 SMA on this chart. But what's really important, guys, is finding strong risk reward setups. And also not being hesitant to the fact that, okay, we did break out. We're not used to seeing trend, but the market may start to go. Based on your textbook technical analysis, we've seen a 2-week coil, a 2-week range. So the market can potentially trade higher for 2 weeks. That's how things, by the textbook definition, work. Now, trading it is obviously not as easy as that, but I'm focusing on, as long as we're trading above this 50 SMA on the 30-minute and the 50 SMA on the hourly, I want to be thinking bullish. I want to be looking for opportunities to buy dips or go long. I'm not looking to short this move. I don't want to stand in front of a moving train. Okay, guys? So last thing I will say here, if you aren't already aware, I dropped a new YouTube video last night that I'm very, very excited about. I'm starting a new tutorial series on the system. Last night's video was simply the basics. What is the system? If you're unfamiliar with the system, how to set it up on your chart, what are the basic 3 key concepts to watch for. In a couple weeks, I'll be coming out with video number 2, so stay tuned for that. But again, very excited. You could go to the Kane Capital YouTube to take a look at that. And if you enjoy the video, I ask that you guys like and subscribe because that helps us out a ton. But all right, guys, that is going to do it for me. Let's now pass it over to Ramsey Rippers, who's got Bet the Bell for us.
All right, big segment today, guys. We can kind of change up the questions a bit. I'm pretty excited. Finally have broken out of this 12 to 13 day range that we've been trading in. So let's get right into it. Broke out of the range, testing 390 in the pre-market. We're up about 0.5% on the indices respectively. Green or red today? Noah.
I will go green. I think that we're going to rally before CPI, and then CPI will send us off a cliff.
All righty. Alejandro.
CPI is going to send us off a cliff. We're going to remember that one. I'm going to go green. Systems and buy. Rip it.
Mander.
I hate stacking one side here, but I got to take green as well. It was a pretty convincing move we saw on Friday with a lot of volume coming in. So I'm on Noah's boat. I think we rally into CPI.
Mo Mamba.
Same here. I'm thinking green today.
Oh my God. Right?
So everybody seems to be forgetting about this magnet that we have at $380 on SPY. I think that CPI probably will send us back down. If not, but I think this magnet will bring us back to 380 one way or another.
So you're going red?
I'm going red.
All righty. All right, Snipes. You're going to fade the team. I love it. Next question. What we're looking at here is what comes first on QQQ Invesco. We're trading at what, 270 right now in the pre-market, just about. Yep, a little bit higher than 270, up about 0.5% again, same as SPY respectively. I want to know what comes first. Are we going 255 or 285 on the Qs? Diamond.
285 is a ways away. 255 is below. Is that below last year's lows?
It's the same distance. They're
lows.
equidistant.
I'm asking if it was below last year's lows. Pay attention, Hondo. I'm going to say 250. There. I'm going to say, yeah, I'll say 255.
This guy's laughing. Look at him. Hondo.
No, he made a good point there. I'm kind of pissed. I didn't realize what he was saying. But I'm going to go 285. Only bullish answers out of me today. I don't care what the question is. I'm going full bull mode. I already decided.
I mean, listen. CPI will be the one to tell us. I don't think we get to 255. We'll see. I don't think we get to 285 or 255 before CPI. So that's definitely going to be the catalyst that brings us there. Money Mander.
That just worried me because I'm thinking there's a lot of people in Alejandro's boat after last Friday that are bulled the fuck up, and that worries me. But I'm gonna take 285 as well.
Wow.
I just think the rally continues. It's like 5.5% above where we're trading at in pre-market here. I saw we're at around 270, so I'm gonna take 285. I think we could see that rally.
Mamba.
I'm taking 255. No shot we get to 285.
No shot we get to 285. You heard it there first. And Stock Sniper.
Yeah, 255 easy.
Easy. You heard it. You heard it from Snipe and then Mo. All right, I'm excited. We're definitely going to come back to these on Friday at the end of the day. So now with that being said, it's going to lead us into our last question of Bet the Bell. A lot of range questions, a lot of questions on, green or red. If over or under 280, 275, or what was the number? 255 and 285, which one are we going to see first? Which, a couple of you guys said we're going to see 285. A couple said 255. So now I just want to know are you guys buying this rally or is it a dead cat bounce? Is this a bear market rally or is this a dead cat bounce from Friday? I want to know if Friday ignited something. Diamond.
Yeah, I mean, like I said before, I think that we rally into CPI to sell off after CPI. So that's sort of like the framework that I'm going to go into the next couple of days with. Obviously, you have to, let price action dictate what you do, but I think that's going to be like my baseline framework for the next couple of days.
Gotcha. So it sounds like you're thinking more of like a dead cat bounce because I wouldn't consider a bear market rally like 3 or 4 days of bull action. Alejandro.
Yep.
I'm gonna say bear market rally. The only thing that scares me here, maybe it actually is working in my favor. I don't know if you guys have seen this 2008 versus 2022 overlay. We've been following that thing to a T, which is kind of showing that we would take a massive, massive move lower soon. So maybe that actually is working in my favor because the chances of that happening are slim. But it's tough to say that on the live show because if something crazy happens over the next month, everybody's going to say, oh, remember when Alejandro was saying that, we weren't going to move down like we did in 2008? Something to watch for. So kind of a long-winded answer, but I'm going to go bear market rally.
Ryan, clip it right now. Clip that. Mander.
Hondo, I'm going to take your back on this one because that cliff saw we saw was a full systematic implosion. We're not in the same situation as we were then, at least not yet. So eventually that chart's not going to pan out as it is right now. I don't know what qualifies as a bear market rally. Would that be like a rally back to the trend line resistance or something? If so, I'm going to take dead cat bounce. I don't really think this holds on for, weeks on end.
Oh, Mambo.
Yeah, we'll get into that in the analysis, but definitely dead cat bounce.
Wow, I'm excited for this analysis.
Me too.
Stock Sniper.
Yeah, this cat's about as dead as it gets.
All right, guys, that does it for Bet the Bell. Alejandro, take it over.
All right, so Mo alluded to it there. We're going to go over to Mo Mamba now for Mamba market analysis. Mo, what do you got for us?
All right, let's get this S&P chart up. All right, so this is the SPY daily time frame. Now, the big range we were looking to get into and the gap fill was that 388 level to 390, right? That's a nice daily gap, a nice daily supply region, right? So the 388 level, we never ended up testing it on that fake out, that huge fake out where we did pump near that level, never filled it, but NFP got us up there finally. We do pay attention to the close. Well, I do. I do pay attention to how the candle closes into these supply zones, demand zones, support and resistance levels, right? So on the daily, we did have a strong close on the daily for bulls, right, into this supply zone. You would like to see that as a bull, but we're not through it yet. The big level you want to watch for today is the top of that shaded supply zone. That level would be 390. That level to me is big on the daily. If we're able to hold it, my next target will be 393.3. I don't want to go too far out. That's how we go about these analysis, is candle by candle. I can sit here and tell you guys, oh, we're going to, I'm thinking we're going to run all the way up here or come back down. No, but let's just go day by day, candle by candle, show what each candle's telling us, right? Today, let's see how we close and ends up telling us where we're headed. If we do get this 390 close above 390, I see us targeting 393.3. That's a great daily level candle. You can see the consolidation above that level was a tough level. And once we broke through to the downside, you can see the drop after that. Now, the big thing I was alluding to earlier was we're not out of the clear because this daily supply could still hold up and could drop us back down. Now, if it does drop us back down, the big level you want to look out for is 383. Remember this range we were stuck in, 378 to 383. I don't care about the, the wicks, the gap ups, and we would close below, right? No, so 383 is if we do reject this daily supply today and close below, I'm aiming for 383. If 383 fails to hold as support, oh baby, we're back within range. And let's just hope this piece of does not come back and stay within range for another week or two, and maybe come back through below 378. If we're able to come back below 378, I don't care about that low. That low you guys see right there, that's why I'm not lining it up there. That was a fake out. That's a nasty fake out. It trapped bears and it faked out bulls. Now, my big thing is if we do come back down through this 383 level, can this 378 hold? If it fails to hold, sayonara. That'll do it.
All right, Mo, we'll keep an eye on that in the days to come. Thank you for sharing your analysis. We're going to start to wrap up the show now with today's top watches. We're going to go around and ask the head traders what it is that they are looking at headed into today, starting with diamond trades.
Yeah, I'll go first. So for me, you guys heard me talk about how I'm sort of expecting a move higher to head lower. I want to see us get into that daily imbalance on the daily chart and dump from there. So I'm sort of watching that as something that needs an objective that needs to be filled, and then we'll head lower.
All right, Mander.
All right, I'm going to get this out as fast as possible because it burns my mouth like habaneros, but I'm watching Meta to the upside. It filled the pre-earnings gap back to like 129.80-ish, closed above 130, and clearly broke above this trendline resistance since dating back to like April. So I think this is a great candidate for upside to like a 140 price target.
That thing looks ready to go. I like it. I like it. All right, and last but not least, Mo.
So some nice flow on this ticker last week. It's up on the hot chains and tickers on unusual wells. So nice clean level. You can see the peak at 42.60. Watch that if we do. I think it's gapped above at the moment, if I'm not mistaken. I saw it earlier before the show. So if we do come back within range, watch that 42.60 and then that 41.95. Now, why didn't I line it up slightly above to that 42.15 level? That's because your RR isn't great, right, at that. So if you do drop, you got good support at 41.96. Now, if we do get through that 41.96, we got a nice move down, a free drop to 41.25.
All right, awesome. Thank you, fellas. That's going to do it for this morning show. Appreciate everybody who tuned in. If you're watching on the YouTube, do us a massive favor and like the stream and subscribe. That helps us out a lot. Good luck trading today, everybody. For those of you that aren't aware, the 6 of us plus Coach Dipka trade all day, every day, live in the Kane Capital Discord. You can go to kane-capital.com if you are interested in joining. Again, good luck today, everybody. Trade smart, manage risk, and we will see you back here on Wednesday morning at 8:30 a.m. Eastern Time. Have an awesome day, everybody.